Hello there, the January rally in equities has started to splutter in recent days, but will all the gains be wiped out, or will we gather some more upward momentum? Well, I've been chatting to Zahid Mahmood from London Capital Group about where we go from here. We've seen the New Year's rally begin to fizzle out slightly over the last few days. Do you expect it to completely reverse, or will it regain some momentum?
I wouldn't necessarily say it's actually fizzled out at the moment. If you look at what's happening in the markets, fine, we're slightly off the highs for the year, although we're not very far into the year. But technically, if anything, I'd consider this a small retracement. And to be fair, given the rally we've had over the last 2 months or so, it makes sense to actually retrace a little bit, some profit taking. There's nothing come closely to what you would call a fizzle out stroke reversal at the moment.
Yeah, sure. But are these multi-year highs that we've seen the FTSE and S&P approach justified? Because essentially nothing has been solved.
You say that, but again, I think there's fundamentals that actually support what's actually been happening over the last couple of months or so. Now, we've had fundamental data that actually supported a global economy that seems to be gradually improving. So you have, for example, the jobs figures in the US that are starting to now show jobs being created. The corporate sector on the whole has generally in the US been quite positive. They've actually come out with reasonable good results in the last few years. You're also seeing an expansion sector in China as well, the two biggest global economies in the world. And aside from that, you're seeing yields, for example, in the European government bonds come down as well, simply because the risk factor has actually, in many people's perceptions, declined. And it's made it a little bit easier for people to take on riskier assets. So the fundamentals tend to support the fact that on the whole, fine, we haven't resolved many of the problems that exist, and maybe there is a bit of can kicking down the road. But ultimately, at the moment, there is so much support around from central governments as well as economic and fundamental data. It kind of justifies where we are, to be honest.
But do you really think that? Because you talk about kicking the can down the road, the Fed have recently said that the Fed are starting to question how much further they're going to implement bond buying. So aren't we approaching that moment where that government help and central bank help is going to fizzle out?
Possibly, I agree. And to be honest, that's something that was always on the cards. Investors had always expected that sooner or later QE would end. It's nonsensical to have indefinite QE. And the fact that they've announced it, I think, in my opinion, is based on the fact that they believe that the US economy, for example, is strong enough to be able to sustain itself beyond QE, which is what we've had over the last few years. And likewise, even in the European Union, although, fine, at the moment, the European governments aren't in the greatest shape, and which is why the ECB has continued to show unlimited support for them. I think the moment that you start seeing a global and specific country economies that are starting to improve and turn around, you'll see the central banks, I should say, coming off the gas and letting the economy run as it should have done prior to what's been happening over the last few years.
What about the US earnings season? That's about to kick off this week.
Yeah.
I'm wondering how strong it's going to be, because surely the final quarter of 2012 would have been weighed down by all the wranglings on Capitol Hill. Surely that's going to affect companies across the States.
I think generally it will do. I totally agree, and I think that will have some of the impact as well. But I think on the whole, just historically over the last few years or so, you'll notice that the US corporate sector on the whole has actually been very resilient. They've, on a number of occasions, actually surprised on the upside rather than the downside. And given all the stimulus and economic support we have had at the moment, I'm still quite bullish the US economy and US corporate sector on the whole. I think there's still a positive upside on those companies.
Over here in Europe, what's the next big event that you're looking at? We've got the Italian elections in February, which will at least be interesting, but do you see any major bumps in the road in the near future?
I think there's always bumps, and I think we're going to have the same as what we had over the last couple of years, in particular last year. I think if things start turning sour again, you're going to start seeing people refocusing on Greece again. Although, right up till towards the end of 2012, many people were actually betting whether Greece would actually leave the European Union or not. Now, although that's kind of declined a little bit, I think the moment things start turning around for the worst again, you're going to start seeing yields on Spanish and Italian government bonds go up again. I mean, Spanish government yields, for example, came down to about 5% recently, which surprised many people considering the state that the Spanish economy is in at the moment. So again, I think, if anything, the only spanners in the works for the European Union would be Spain, Italy, and Greece, as far as I can see.
So where do you see us going for the rest of January, at least in terms of the major equity indices, the S&P and the FTSE?
I think the indices, equity index markets in particular, have got momentum behind them right now. Fine, we might see a little bit of retracement, we might see a little bit of pausing. On the whole, I think the markets, in my belief, are going to possibly hold up, maybe grind a little bit higher. Simply because at the moment, especially in January, you are getting a bit of a January effect going on where investors are now piling back into equities. But at the same time, there's no real fundamental reason why you'd want to be selling right now. Again, there's no great reason why you'd want to be buying. But obviously, if there's no reason either way, markets tend to continue in the same direction doing prior. And in my opinion, I think, at least for January, although there are other issues further on down the line, but certainly for January, I think we're probably sitting at the highs, maybe go a little bit higher, as far as I can tell.
And just to finish off, one question I'm asking all my guests at the beginning of this year is whether we're moving beyond this idea of risk on and risk off and actually starting to analyse fundamentals for each individual country more and more.
I think that's certainly a factor. Over the last couple of years, obviously, most the risk on, risk off scenarios have been played by how governments and in particular central banks have been acting towards what's been happening in the markets. I think in my opinion, you're going to start seeing generally central banks starting to back off a little bit off the accelerator in terms of the amount of QE that they're providing. And as I mentioned before, the Fed's already hinted that they're going to consider to possibly do that. So again, yeah, it will be. I think we'll be going back to what we should have been doing maybe 3 or 4 years ago, prior to, unfortunately, the great disaster we've had over the last couple of years.
Well, that's all for Moments. Keep an eye out for an interview with Craig Erlen from Alpari. We'll be discussing the upcoming BOE and ECB meetings, but for now, goodbye.